This is page 59, question 3. Okay. So part A of that question is the payout is greater than 40. So year 0. Okay. We told this will be equal to the payout is 30. You paid 13 out of 30. Year 1, you paid out, the company paid out 13.2 out of 31.8. Okay. Year 2, year 3, year 2, the payment paid 13.3, and the earnings for that year was at 3.9, and year 3, the payout, the payout dividend was 15 out of that 5.7. Year 0 was the payout.
%43.3%.
43.3. Year 1.
41.5.
41.5%. Year 2.
39.23.
That's 9.23. That's 9.2%. Okay. Year 3.
42.02.
42.02%. Okay. So if the payout A is greater than 4% in every year, however, okay, is not greater than that was 40% in year 2 because it's that's 9.2%. That's why that statement is therefore not correct. Okay, that is part A. Part B, the mean growth in dividend per share over the period is 4%. Okay, let's see. In year 0, the dividend, okay, we call it D0, okay, is 13. D3, that is almost like 3 years later, it is equal to 15. 13 to 15, yes, okay. Therefore, D3, the dividend for year 3, okay, is equal to D0, okay, 3 years of growth, okay, to the power of 3. So the question is that what is therefore the growth, or the G, the growth in the dividend, okay, to be equal to G will be equal to D3 divided by D0, okay, the power of a third minus 1, of course, okay. This therefore, it grew from 13 to 15, 15 divided by 13, and this growth has been experienced over 3 years. Therefore, the power of a third minus 1. And you get how much will be therefore the mean growth over those 3 years?
4.89.
4.89%. 4.89%. Here, the mean growth is 4%, which is wrong. It is 4.89%. It's not 4%. That's why B is not correct. Okay. Then C, the return for that year, the shareholders' return for that year is 26%. Okay, that year. Okay, return to the shareholder that year is P1 minus P0. Okay, plus the dividend. Okay, we divide by P0. Okay, for that year, P, the share price end of that year, is equal to 2.25. 2.25. P0, the share price end of the previous year, 2.01. Plus the dividend paid for the third year, which is 15 cents, 0.15, divided by P0, 2.01. Of course, we express as a percent. And what do you get?
%19.4%.
19.4%. And they're saying that in the answer, they're saying it is 26%. Of course, therefore, that's also wrong. Okay, so remain with D. But anyway, let's do with C. Okay, so in answer D, the mean growth in earnings per share over the period is 6%. Let's see. The earnings, let me call this E 3, okay, earnings, just represent earnings per share, is equal to the earning per share at year 0, 3 years of growth, okay, to the power of 3. So you want to get towards the growth, therefore, in the earnings over those 3 years, okay, every year for sure, okay. It'll be equal to, therefore, the earnings that 5.7 divided by 30, okay, it has grown from 30 to that 5.7, but over 3 years, therefore, power over 3 to the power of that, minus 1. Therefore, what's the G?
5.97.
5.97, okay, which is more or less equal to like 6%, okay. That's a simple question which you can evaluate. In this question, you have to rate more or less like every choice that is given to you, okay. Question on that question?
Sir,
Yes, sure.
where do you get these formulas?
Oh, okay. Generally, okay, there are two ways of trying to get the mean. They have called the use of arithmetic mean, I think, which of course I know most of you you normally use, okay, and you have called the geometric mean. Geometric mean, okay. So arithmetic mean is where you do, for example, year 1 individually, year 2 individually, year 3 individually, then you divide by 3, isn't it? I think that's what you're more used to.
I have an issue.
Yeah.
Yeah, that's called the use of arithmetic mean. Okay. However, we also call a geometric mean. Okay. So in case you don't want to get what we call to smooth out, don't forget the mean growth. The arithmetic mean, what normally does that, we are going to get the mean for each of the year, with some years that can be very high, other years that can be very low. So it is not the best way of trying to get the mean. Okay. Geometric mean, it tries to what we call in quote smooth out, okay, or the roughness of the growth, okay, or the mean. Okay. So geometric mean, okay, simply, for example, you want to get the mean for example, for 2 years, okay, it's like what do you call, it's like compounding, okay, which I think you have done that is in the past, what we call compounding, okay. You want to get, for example, the price of commodity is increasing, okay. For example, the price, let me guess, for example, okay, year 0, year 1, year 2, okay. The price, for example, of commodity, okay, in year 0, that is, for example, today, is $10, okay. We'll be told that every year it is increasing by 10%. Therefore, in year 1, the price will be equal to, okay, 11.10%. Yes, it will be 11, okay. Then year 2, it will be equal to 12.1. I'm assuming that every year the price is increasing by 10%. So between year 1, the price in year 1 will be 11. The price in year 2 will be 12 point something, 12.1, I guess. 12.1, yes, okay, to be 12.1, okay. So in case you do want to get towards the price in year 2, okay, without the need for you to do every year, okay, what you can do is simply say price, this to be price, okay. Price for year 2 is equal to price for year 0 with the 2 years of growth, 1 plus G, okay, squared, because between year 0 and year 2, there are 2 years, okay. Which means therefore, okay, the price for the G, the growth, we already know the growth. Here we know it is 10% every year, okay? But you just want to confirm, okay? Therefore, we can see that for the growth between years 0 and year 2 every year will be equal to P2 divided by P naught, okay? To the power of a quarter to the power of a half minus 1. All I'm making here, I'm making G the subject of the formula, okay? I've made G the subject of the formula, the growth the subject of the formula, okay? Don't forget just to show you, okay? P2 is equal to P naught 1 plus G squared. You can divide by P naught both sides, divide by P naught both sides, so it cancels out, okay? So here you'll be having P2 divided by P naught is equal to 1 plus G squared, okay? So what can you do here? You can therefore multiply by the power of a half. This goes, and you do the same with this other side, the power of a half. Therefore, we remain with the G here, okay? Therefore, to be P2 divided by P naught, the power of half is equal to 1 plus G. Because here they have the 2 has already gone, the square has already gone. And you make the simple formula. G is equal to P2 divided by P naught, the power of half. These are plus, becomes a minus 1. So I'm still making G the sum of the formula. Okay. Don't forget here, okay, the main advantage of using the geometric mean, is that we get a constant growth, okay, for every year, irrespective of those years where there was maybe high growth, other years low growth, okay. So we want to get a constant growth in either the earnings per share, in the dividend, by the use of the geometric mean. But you can also use the arithmetic mean, okay. So don't forget here, for example, okay, because the growth is the same every year, okay, here it is 10%, here is 10%, the arithmetic mean is 10% plus 10% divided by 2, and you get 10%, okay. The same thing will apply even in the case of the geometric mean, okay. That's because the growth is same even for the case of the arithmetic mean, even for geometric mean to be also be the same, okay. Like for example here, 12 P2 is 12.1 divided by 10, which is P naught, okay, the power of half minus 1, and you get 10% also. Okay, so most often not, okay, it is better to use the arithmetic mean, but you can also use geometric mean. You can also use geometric mean, but you can also use arithmetic mean, but it's going to be out of work for you. It is not going to help you in answering the question. So for most cases, unless I was told to use arithmetic mean, use geometric mean. Is that clear?
Yes, sir. Thank you.
Okay, thank you. Yeah, so that's where the formulas were coming from. Okay, but it's not that it's just I was using geometric mean, not arithmetic mean. Okay, to get those mean growth. Okay. Okay, I think that's good enough to mark. Now, I don't know whether there's a question here I've seen, which I think we can also attempt to answer. That was question 3. Have we done question 4? This question 4, this is the same page, the same sitting, that is.
Yes.
You've done it already? Wow, okay. Question 5. Even question 5, I think we have done it already, isn't it? Question 5, have we done it?
I don't remember doing it.
Oh, okay, fair enough. Okay, go through it and we can discuss together the question 5.
Excuse, I have an issue.
Sure, ask.
Me, I don't know what is going on here.
Why? What's happening?
You are asking questions like you have really taught these things.
Yeah, because you have already taught them. We have gone them through together. Or you came late.
When?
Last week we had a class. This is our 5th class.
Okay. Can you ask about if we'll be given textbooks first?
Sorry?
Can you ask the management if they are giving us textbooks for this unit?
I think one of you has a question to Christine, and she's yet to respond. So we wait for her response because I think Christine is aware of the issue. I think one of you did that already, isn't it? I think one of you did ask
Yes.
Christine about the textbook. Yeah. So I guess she will answer. If maybe she doesn't answer, I will try to follow up.
Okay, thank you.
Okay. Sorry about that, Nelson. Dog, this is already our 5th class already. Maybe we joined a bit late. Anyway, so what's the answer? Question 4. Sanya, what's the answer?
So just a few seconds, I'm going through again.
Okay. So this same one reason we are share return return on equity can be defined as profit before interest and tax divided by shareholders funds. Okay, let's go through each one of them. Then we see what could be the answer. Okay, so the following statement is not correct. Okay, return on capital employed. Okay, so let me actually get an image of this question. Then go to our working area. Okay, so you can that in part A, a return on capital employed. Okay, we see that return on capital employed is given us the profit before interest and tax. We divide by total capital. Okay, that's the formula I think we did discuss. Of course, we express as a percent. So let's see A. What is saying? Return on capital employed can be defined as profit before interest and tax divided by sum of shareholders fund and prior charge capital. Yeah, which is okay. But don't forget, prior charge capital are those capital providers, okay, who rank before the shareholders, okay. Therefore, the capital is therefore equity plus all other provider of capital who rank before you, the so-called the prior charge capital. So it makes sense that that's true, okay. The prior charge capital. That's how we get therefore the return on capital employed, which is correct. A, okay. B, return on capital employed is the product of net profit margin and net asset turnover. Okay, let's go ahead and make this distinction. Okay, you can further, what can you say? You do a further analysis on the return on capital employed. Okay, we see that it is given us profit before interest tax divided by capital. Okay, what is capital, by the way? Those account equation, if you already know. We say capital is equal to in the financial accounting, the beginning papers you did mention this. Capital is equal to
Plus equity.
sorry.
Assets minus liabilities.
Capital is equal to asset plus liability. Now here, don't forget that is equity capital. Okay, what you have to find there is equity capital. That equity capital is more or less capital is equal to the assets of the firm. Asset capital is equal to asset plus liability. That give us the amount of. Is that correct?
Assets minus liabilities.
Yes, that is not plus. That's what I'm trying to wonder. How is it a plus? It's asset minus liability. Okay, That's the equity capital. Okay, that is equity capital. Okay, when you meet therefore, we can say assets of the firm, assets, that is A is equal to the equity capital plus liability, isn't it? Just making A the subject of the formula. That asset is equal to equity capital plus liability. What is liability? The prior capital providers of funds you have. Okay, therefore, this is our capital here, which means therefore you can replace it with asset. Okay, therefore, we can say therefore return on capital employed is profit before interest tax we divide by assets. And the same is going to give the same answer at the end of the day. Okay. Further, we can say that if I was to use sales, okay, let me use sales here. I can say the equation further can be profit before interest and tax divided by sales times sales over assets. Don't forget that this can cancel each other out. Okay, we go back to our original equation that profit return on capital employed can be equal to the profit before tax we divide by assets. Clear so far?
Sir, I don't get how you're getting assets. Like
in the normal way you draw the balance sheet. Okay, how do you say what's assets? Don't forget the statement of financial position has to balance, isn't it?
Yes.
So what's the figure of the? Let me just you just want to say that this is non-current assets, current assets, XX. Then here you have equity, isn't it? X amount. Then you have liability, X amount, XX, and the equation is balanced, isn't it?
Yes.
This is a simple balance sheet I'm trying to draw here. Isn't it? That's how you draw it. Equity, then you have non-current liability, and you have current liability. The two has to balance, isn't it? The two.
Yes.
Yes. Then I'm trying to say that therefore asset is the same as equity plus liability. Because the two have to balance, these figures have to balance either way. Therefore, company assets is equal to therefore equity capital plus liability, the prior charge capital. Is that clear?
Oh yeah, okay.
You get it?
Yes.
Okay, that's why I have here on the capital part. I've replaced it with the asset value, the total asset value, the current and non-current assets. It's the same thing because these two figures are the same. These two figures are equal. Okay. Then here I went further and introduced maybe a sales figure here. Okay, that we can further disintegrate. Okay, the equation to profit before income tax divided by sales times sales over assets. Okay, then the two will cancel each other. Okay, where is it? Okay, the two cancel each other. We go back to our equation here. Okay, therefore, this is our we can call it profit margin. Okay, this is therefore like the operating profit margin. Okay, and this therefore, what's this? This is a question. Assets, sales of assets. What do you call it? Sales of assets. What do you call it? Nafisa.
Yes.
What is sales divided by assets?
I don't know.
No idea.
Yeah.
Okay. Anita in class. Anita.
Yes.
What do you call sales of assets?
Asset turnover.
It's called the asset turnover. Okay, it's called the assets turnover. It's called the assets turnover. Okay, this is the asset turnover. Okay, that for every dollar of investment the company has made towards the asset. Okay, how much because the term to use, how much have you been, how much has it been able to make for the company in terms of sales, okay, towards the conversion, okay, has been able to make for the company. So B seems a bit okay, okay, B seems to be a bit okay, okay. Let's go to C, okay, we see. C, dividend yield, okay, which I think we discussed already, dividend yield. It is given us the DPS, dividend per share, we divide by the market price per share, okay? That's the dividend yield, okay? Which was D naught divided by P naught. Hope you still remember, okay? Can be defined as dividend per share divided by X dividend market price per share, which of course is correct, okay? Is the DPS, we divide by the market price per share, okay? Of course, without the dividend, okay? The share price without the dividend, we call the X dividend, the market price per share. So C is correct. Let's look at D, return on equity. So return on equity, okay, we see given as net income. We divide by equity, the equity capital now, because we express as a percent. That was the return on equity. Okay, actually you can further subdivide this equation, disintegrate, not subdivide, disintegrate it a bit further. We say return on equity is equal to net income divided by sales times sales divided by assets times assets divided by equity. Okay, if we can, these two cancel each other out, we go back to original equation, which is net income divided by equity. Okay, so this therefore is our net profit margin. Okay, profit margin. Sales of asset, you said it's called the asset turnover. Asset turnover. Okay, and this generally, okay, assets, if you have to assume that the firm is wholly financed by equity shareholder, okay, if you assume the firm is wholly financed by equity shareholder, don't forget therefore assets is equal to equity. Okay, if you have to assume that way, that the company is financed wholly by equity shareholder, then asset is equal to equity. Therefore, conventionally this therefore can be equal to 1, because assets divided by equity to give us 1. Okay, and let's see what they're saying. The return on equity can be defined as profit before interest tax divided by shareholders' fund. No, that can't be. Okay, that can't be. So there we can therefore our answer, because the question was asking which one is not correct. Okay, and we have answer to be D. Okay, is it clear by the way? Okay, this further. Yeah, sure. Who is okay? Go ahead.
Sanya here. Okay, so for return on equity, for me, I thought it's the answer because the formula is profit after tax, right?
For the return on equity, you also the answer is
it's D, but I thought it's because the formula for return on equity is not profit before income tax, it's profit after tax.
Yes, that's why D is wrong. So that's why D is our answer.
Yeah, so okay, yeah, that's so what I thought is right too.
Yes, it is. Yes, it is.
Okay.
Yes, our answer is D, because it is not there is net income. Okay, is net income is profit after tax, not profit before interest and tax, as they're telling us in part D. Okay. So yeah, that is it. So you can see the examiner sometimes can twist things here and there. Okay, to see how well you understand the concepts. Okay. Now, today I want us to introduce a simple bit, okay, so that we can answer question 8, okay, a very small bit of the syllabus, question 8, what I will call the agency theory, the theory of agency. Okay, then we answer that part D, question 8, what call the agency theory. Now, the agency theory is a bit extensive, okay, and actually I will only discuss the agency theory between shareholders and the managers, okay. We have shareholders and debt holders, okay. I have the notes here. However, I will not go through it, okay, for the sake of our own interest, because, okay, for the last 14 years, it has not been asked. So I'll not go through it. Okay, so, but I'll leave them notes just in case you don't want to go through shareholders and debt holders. So discuss what matters, shareholders and equity, shareholders and the managers. Now, agency theory, which I think you already discussed, you discussed in corporate law, corporate and business law. Okay, this is called corporate law. Yes. Okay, the order 4. Okay. And now agency theory exists where we have two people. Okay, what we call an agent and what we refer to as a principal. Okay, and we say that the key distinction between these two parties is the principal is one who is going to be appointed. Okay, is one who is going to be in quote giving a direction to the agent on how things are meant to be carried out. Okay, and of course the agent at the end of the day will have to in quote account, okay, to the owner of the resource, the owner of the business, for example, okay, on how they have utilized his resource. Okay, don't forget the actions of, I think we discussed this in law, the action of the agent can tie down the principal. Okay, because don't forget the agent is acting on your behalf as a principal. Okay. Anyway, of key concern, okay, as 3, okay, shareholders was management, shareholders was bondholders, shareholders was management, and the government. Okay, as mentioned, I want to discuss the first one. Shareholder was the management. Okay, that is what seems to be relevant for us more. But the notes are here just in case you don't want to discuss more. Okay. Either way, so you say that an agency relationship is going to exist when you have two parties, one called an agent and the other one called a principal. Okay, the agent, of course, as I mentioned, is going to be carrying out, or his decision, his action are going to be in quote guided by the objective, by what he was appointed to do the work for. Okay, so because therefore he's going to go back to the contract of appointment. Okay, let's call the agent contracts. Okay, that refers to what should I do and what should I not do. Okay, in quote. Okay. Now, if you have to take the example of shareholders was the management. Okay, who is the principal and who is the agent? Okay, no, I know it's kind of pretty obvious question, but who is the principal and who is the agent in this case? Sakina.
The shareholders are the principals and management is the agent.
Yes, the shareholders are the principal, okay? And the best way by that to identify a principal is simply to observe, okay, who owns the resource, okay? Who is the owner of the resource, okay? Because the owner of the resource, therefore, is one who will be the principal, okay? The party that is going to be appointed, okay, to carry out some decision on behalf of the principal become, therefore, the agent, okay? Check who accounts to the other, okay? Who is going to be in quote be presenting? This is what you gave me, okay, at the beginning of the year, and this is what I've been able to achieve, okay, through the resource you gave me. So that will come there for the agent, okay, like the way the manager or the management normally carry out, prepare the financial statement and present them to the shareholder at the AGM, okay. This is the company you gave us to manage during the year. This is what we have been able to perform. Okay, this is the profit you have made. Okay, this is the loss you have made. This is the company asset position. So therefore, the managers are the agent, which you are. Okay. Now, why would you, for example, okay? Don't forget at the end of the day, okay? If it will be possible, okay, to have what we call a case where you are the owner of the business and you are the one who do manage your own business, then that can be quite good. Okay, if that can happen. That you are the owner of the business at the same time you also you're the manager. Okay? If that can happen, then it will make things a bit easier. In what way? Okay, in the sense that there's some things that you are able to understand better in terms of your business, okay, as opposed to having someone else coming to manage your own business. Okay, you're able to do things in a much better way. Okay, compared to a case where you will be asking someone else to be managing business. Okay, however, sometimes you can have cases where that's not possible. You may have to, in quote, appoint managers. Okay, you may have to be appointing managers who are going to be running your business. Why would that be the case? One of them, because there might be too many of you. Okay, if it's a family business, then you might be few, which means therefore it is possible for you to be the owner and the manager at the same time. But in case you're looking at a case of a public listed company, then that might not be possible because there are too many of you. Okay, example, take the case of Safaricom. How many shares does it have? Okay, it runs to hundreds of thousands. Okay, Which means therefore, if all of them are to come and manage the farm, okay, what chaos would it be? Okay, a lot of chaos for sure. Okay, so seeing there are too many of them, then what do? They have to seek and try to see, can we appoint even some of us maybe, okay, or even some other independent parties to come and manage our department, to manage our company, okay, because there's too many of you. Then not all of you are business managers, okay. You don't. Most of you have the skill to run the business, okay. So look for experts, okay, to run your business, okay. As you can see, therefore, they lack the technical skills are required to effectively run a business, okay. So look for someone who have that experience, someone who have that required skills level, okay, to run your business in an effective manner, okay. And of course, most of you, as you also may, geographically dispersed, okay? Not like your family business, okay, where all of you are the same in quote compound. No, okay? In the case of a public listed company, okay, you're not in the same compound, okay? You're all over stretched over the entire world, okay, for example, okay? So therefore, you can't all of you be the same location at the same time, okay? And then you have the case of time constraint, okay? Of course, don't forget, you may not be able to say that I can't be able to commit myself 100% to my business. So what do I do? Therefore, I need to appoint someone else who's going to be there in quote full time. Okay. So because of this and many other reasons, that's why you can see therefore there's a need for the shareholder to appoint the managers, okay, to run their business, okay, to run their business, okay. And as you mentioned, okay, don't forget that shareholders are the principal and the managers are the agent. However, okay, don't forget, you having someone else running your business, there will always be problems that are going to arise, okay? What we call the agency conflict. There will be problems, okay? That whatever you want, the idea you had originally, you as the owner of the business, okay, might not be maybe the one that is being pursued by the managers, okay? They may be pursuing their own individual interests, for example, okay? So there will be conflicts, okay, which is going to be arising between the two of you. You as the manager, for example, and the shareholders. There will be conflict that will be arising, okay? So therefore, you as a shareholder, you are the owner of the business, okay? If the company was to fail, it is your company that's going to fail, okay? Not the managers. Managers, of it, they will jump ship and go to the next company, okay? Be employed there, for example, okay? So yeah, the main person who's going to be in quote failing, it's you as the shareholder. So you have to foresee some of these problems in advance, okay? Try to see what can we do that is going to ensure that we prevent these problems from occurring, okay? So therefore, what are some of the sort of the conflict can have, okay? One of them is called the problem of motivation, okay? Where the managers you have, okay, they are not motivated, okay? They are there just to, in quote, have the day come to an end so that they can earn their salaries, they can earn their wages, okay? So this is the big problem for sure. You want to have managers who in themselves, they're self-driven, okay? To go to the extra length, okay? Not just remain where they are, okay? So if, for example, you do pay your managers a fixed salary, then that's a problem, okay? You may want to see what can we do in order to motivate them better. Okay? For example, we can have a deal with them, okay? We are going to be giving you performance contracts, okay? Such that your pay is pegged on how you perform, okay? So this can be one of the solutions you can put in place, okay? However, don't forget, it's better you see how motivated our managers, how motivated are our executive. Are they willing to go the extra length, okay? If they're not willing to go to the extra length, then you have a problem, okay? See what you can do to motivate them, for example, okay? Then you have a case of the consumption of high perquisites, okay? And this is going to occur in cases where maybe this company does not have what you can call a board, for example, okay? So it is the managers in quotes, okay, who design their pay, okay? If that happened where it is a manager who design how much they pay themselves, then of course you're going to be sure they're going to be paying themselves high salaries, okay, high bonuses, okay, what we call perks, okay. Of course, in case they're paying themselves high salaries, high wages, okay, what does it imply? It implies, therefore, that you're going to have a high wage bill. That's an expense to you, okay. Of course, therefore, it is reducing your profit as the shareholders of the business, okay. But in case you have a company that has a very effective board, okay, where you have the separation of the board and the day-to-day management, then of course that problem may not exist. Okay, we assume it may not exist. Okay, because the board members, okay, will be there to protect your interests as a shareholder. Okay, against even the manager themselves. Okay, so that the manager themselves they don't overpay themselves, for example. Okay, before any pay is made to them, they might require the approval of the board of director, for example. Okay. then you have got difference in risk profile. What does that mean? It means, therefore, if we are to consider, okay, and let me just explain through my writing area here. If, for example, the company was to fail, okay, this is called risk profile. This is the risk profile. If, for example, the company was to fail, okay, who partakes of the, if the company was to be successful, okay, assume we have two companies. Let me give you a simple example. We have company A, we have company B, okay. This is a profit that the two companies make, okay. Company A makes a profit of, let's say, $10 million. Company makes a profit of, let's say, $1 billion. Between the two, who do you think takes a high pay? As the managers of the two companies. Where do you think the managers are paid more? In company A or in company B? The take home to the managers.
Company B.
Yeah, definitely be company B. Okay, company B most of the time, okay, they are the one who are going to be taking a higher pay, okay, compared to a company B. This seems to be a small company, okay, not so small, but it seems to be a small company, okay. However, it will most likely not always a guarantee, but most likely company managers in company B, okay, will generally be having higher pay, okay. Now, if the two companies were to fail, assume company A was to fail and company B was to fail, who will take a higher, in quotes, which manager suffers more? Assume the two companies was to be liquidated, okay? What would be the cause of the liquidation? A and B, okay? Where do you have the greatest suffering among the managers? I thought that's very obvious.
Company
Collins,
A.
Company A, they suffer more. Why do you think that that's the case? Companies, they suffer more.
Okay, in my opinion, during the liquidation of the both companies, definitely company B has more money in liquid form than company A. So if the managers are going to go home, managers in company B will take much more home than managers in company A.
So their take home is going to be greater than in company B. Okay. Let me give even a practical example. Yes, Tuskys and Nakumat. Okay, I think that could be a practical example. I think Nakumat was much bigger than Tuskys for sure. Okay, but assuming that you are manager in Tuskys, you are manager in Nakumat, two companies. Assume that, I don't know, I hope it's going to survive, but assume that now the Tuskys has closed down shop. Okay, where do you have more suffering? Is it the managers in Tuskys or managers in Nakumat?
Just a question. Like, what's our definition of suffering? Because
I don't know.
you can say on one hand, the bigger companies' managers will suffer more because they'll be under more scrutiny due to the failure. Or you can say the smaller companies' managers will suffer more because, like the other person said, they won't take home as much because they
That's
have
much. Okay.
So I'm not sure.
Okay, yeah, I see your point. Now, let me even refine it in a much better way. How do I refine the question? The two companies has failed. Anyway, I don't know what to point out, how to put it across in a better way. But either way, what I'm trying to bring across is that if the two companies were to fail, then the managers, don't forget the managers in both cases, they rank the same way, okay? Which means therefore, if they'll be paid to meet, the ranking or the payment, it will be the same, okay? In the sense that you as managers in company A, you'll be paid after the company has paid the government taxes, it has paid the creditors of the company. So in terms of ranking, you rank the same. It does not matter whether in company A or in company B. Okay. So maybe in terms of the due payment of the dues, okay, which is going to be a 3-month salary, okay, to pay the 3-month salary in advance if the company has the money, that is, okay. So in case the company is closing today, then you must manager in company A, okay, and in company B, you paid the salary for the month of October, October, November, and the December. Both of you, so that the company has the same asset to be able to pay you off, okay. But at the end of the day, once that is done, okay, you are all going to be jobless, isn't it? You as manager in company A, you as manager in company B. At the end of the process, you're going to be jobless, okay? What do you mean, therefore, you're all both suffering, okay? Which means that it does not matter whether you are in company A, which is a small company, or in company B, which is a big company, okay? Both of you will be suffering. You have to go out and start looking for jobs, in short, okay? So in terms of failure, okay, the failure might, in terms of the result of the failure, okay, you being unemployed is the same, whether in company A or in company B. Because you do not partake, and of course, the shareholder in company B will suffer more if the company was to fail, because then they are a big company, okay? So at the end of the day, the shareholders suffers more, okay, if the company was to fail. But the managers partake of the success of the company more in company B. But in terms of, let's say, the risk side of it, okay, there's risk they don't have that much. They are able to get high returns, okay, because the company is doing well. However, if the company is going in the opposite direction, the company seems to be failing, they don't partake of that failure, okay. That's what I want to mean, okay. Even a simple example, if this company was to make a loss, okay, of, let's say, it makes a loss of 1 million, and this company makes a loss of 100 million, it does not mean that because company B they were being paid higher salaries before, they're going to be sharing of this loss the company is making. No, they won't. These are managers, okay? They are employees. They don't partake of the losses you're making, but they can partake of the profit that you're making. You cannot tell the managers, hey, we're going to, or we will, okay, ask you to take a share of the loss you've made. But in terms of profit, they'll become a share of the profit that you're making, okay? So that would mean, therefore, since they are more towards the risk assumption to the managers a bit low, okay, then they may tend, okay, not always going to be the case, but they may tend to invest in high risk investment, okay. So they may end up investing in high risk investment. Why? Because these are high risk investment, which means more or less most of the time they have a high chance of making high profits. Something good for sure, okay, that there's a chance that the company might high profit, okay. Don't forget, in case you don't invest, if you don't assume risk, then quite likely you won't be able to make money. That one is for sure, okay. That is a basic financial management principle, okay, that in case you do want to make money, then you must be willing to assume risk, because it's no asset that you're going to be getting high rewards with zero risk. It's not possible, okay. It's quite unlikely that's going to happen, okay. Anyway, so the managers might therefore have an appetite, okay, for high risk investment, high risk projects, because they know, okay, or they may have that, attitude that if this project goes well, then we are going to make a lot of money, okay. We as the managers, okay, we partake of the high gains. However, don't forget, this is a high risk investment, so the chance of it even failing is also high, okay. The chance of it failing is also high. But we as managers, do we partake of the losses that company can make? No. Like I said, therefore, the managers might have therefore that attitude that they can, or that appetite for high risk investment. Because if it makes it become successful, we are the one who are going to be will be like sort of be congratulated. We are going to be rewarded. Okay. However, if it fails, we don't partake of the losses. That's the problem with the managers having a high appetite for these projects, okay? Now, for the shareholder, what do they want? Is the reverse. They want high profit, but they don't want to assume risk, okay? If it is possible for them to get high returns, high cash flows, with zero assumption of risk, they're better off. Therefore, investors, okay, the managers have a high appetite for risky projects. The shareholders are risk averse. Let me use that term. Okay, they're more of risk averse. They don't want to assume projects unless those projects can generate compensatory returns. Okay, they are risk averse, and the managers, okay, they're more towards a high. They have a high affinity for high risky projects. That's the problem. Okay, the two of you, okay, you seem to have a different way of trying to look at the projects. Okay, we as shareholder, we want to invest in projects that are very minimal risk, but we want high returns. The managers, they don't, in quote, let's say, they don't care about the investment they're going to make because they may end up investing in high risk projects because they have the chance of making out of money, okay, but they won't partake of losses. So in quote, is that they're not in quote going to be responsible, okay, for the failure of those projects. That's the kind of the problem. But you have two people who have different way of trying to look at the risk. Okay, is that clear? I hope it's clear. Okay, that's what we mean by the risk profile, okay, between the two, the managers and the shareholders, okay. Then of course you have pursuit of power and self-esteem goals, okay. Now, we may have cases, okay, where the managers, okay, when it comes to making acquisitions, when it comes to investing shareholders' money, okay, don't forget they need to look at, is this investment going to increase the wealth of the shareholders? That's ought to be the key question they need to ask themselves. We want to invest in, we as Kengen, we want to invest in geothermal. It's a simply a good investment. But ask yourself, is this geothermal project going to increase the wealth of our investors? If it will, then that's going to be a good investment. Okay, go ahead and do it. However, you may have cases, okay, where the managers choose investment not because those investments are going to yield any returns, but because we would want to be safe. For example, okay, let me quote, okay, like we are pursuing the green energy projects, okay, we are pursuing the green energy projects not because this project is going to lead to any increase in the value of shareholder, but because in quote we want to keep up with the trend. Okay, let me an example. Okay. So what investment are you making? Okay, is it meant to increase the other shareholder, or do you want to make an investment for your own, in quote, personal agendas? You as the managers, okay, that's the problem. Okay, don't forget, by the way, okay, the payment of the take home. Okay, let me call that take home of the managers is also dependent on the asset that they control. What is the asset under your control? Okay, how many assets do you control? What's the value of the asset you control? Okay, if you control less valuable assets, then of course, even definitely your pay as a manager is going to be a bit smaller. Okay, if compared to a company where the managers, okay, their span of control, their span of control is on assets that are value adding. Okay, so you may have cases where managers, they know that if I would want to increase my pay, then I have to look at organic growth of the company. Okay, this organic is not. I will look for growth through acquisition other than growth through organic. Organic growth is where you grow literally. Okay, you have one business. Okay, with the time it grows. Okay, you open one branch, two branches, three branches. Okay. Example, case of case of Naivas, for example. Okay, so your growth is internal, what we call the organic growth. Okay, which could be good because it means your growth is sustainable because you're growing because of what you're making from one branch to the other branch. Okay, however, you can also have a growth that is, let me call it inorganic. Okay, through acquisition. Okay, you have Facebook. Okay, what do? Let's acquire WhatsApp. Let's acquire Instagram. Okay, that's a growth through what we call an inorganic growth. Okay, growth through acquisition of other companies. Okay, it can be good definitely. Okay, company acquiring the other company, it can be good definitely if it is going to lead you, okay, to be able to advance the interests of the shareholders. Okay, however, you go back to the same question. Okay, now was this acquisition done for the managers or was it done for the purpose of the shareholders? Okay. So some acquisitions are not made for the sake of the shareholders, but for the sake of the own interest of the managers. Okay. And of course, don't forget the managers are the one going to convince your shareholder this investment is a good investment. Let's go ahead and put our money in it. Okay, they are the one who are going to convince you. And the AGM, of course, they're in quotes going to be more knowledgeable in that context compared to us, the shareholders. Okay. So the question boils down is, what was the purpose of this project? Is it to advance shareholders' wealth, to advance shareholders' interest, or was it for the sole purpose of the managers themselves? Okay. Then you have case of creative accounting, account manipulation. Okay. This I think we didn't mention when we were discussing on the profit objective. Okay. That the managers are the one who prepare the accounts of the company. So they may, okay, not always the case, but they may, okay, end up manipulating the accounts of the company, okay, misrepresenting the company financial position. For example, they report a profit, whereas the company actually made a loss, okay. Those are for the problems we have with profit objective, okay, which also comes here, okay. It can also be an agency conflict between shareholders and the managers. As we mentioned, don't forget, you as a shareholder, you are the one who owns the company, okay? So therefore, you take actions, okay, that are meant to address this problem, okay? One of them, for example, I think we have already mentioned, is pegging the compensation to performance, okay? Where they pay to the managers or giving the managers a performance-based contract, okay? So the managers are paid based on maybe how the company is performing, okay? For example, you can say that your pay, okay, half of your pay is fixed, the other half is variable. And by variable, it means it is pegged on how the company is performing. Okay, you can see that you, but at the end of the day, okay, you become a sharer, okay, of the profit we do make. Okay, so in case we make profit, or in case the target profit was 10 million, okay, you can see that any extra profit that we make above the target of 10 million, we shall be sharing with you as managers. Okay, therefore, in quote, the managers are motivated to go and over and above the 10 million, because in the extra above 10 million, they shall become partakers of that profit. Okay. And of course, you can have threat of firing the managers. So okay, these are your employees. Okay, of course, therefore, you may want to have them target that hey, your contract renewal is pegged on you performing. Okay, that's always good. In itself is a subtle way of telling them that hey, there's a threat of you firing you. If you do not achieve this, then it's going to happen. So giving them contracts, okay, that is pegged, the renewal of those contracts is pegged on how they are performing. Okay, sort of we are trying to nudge them. Hey, you have to go above, okay, over and above. Otherwise, we won't renew your contract. Okay. Corporate governance, okay, or called the corporate governance. I think one of them, the key element of corporate governance is the board of directors, which I think we discussed today together. Okay, having an effective board of directors, okay, who are meant to ensure your interests as shareholder, okay, are well taken care of. Okay, not just taken care of, but the managers themselves every day they are there to pursue the interest of the company. Okay, not their own personal interest, but the interest of the company. Then you have to call the executive share option plan. Okay, now in this case, okay, what you do is that you as the company, okay, the shareholder that is, you offer managers shares, okay, option of them buying shares from the company. Okay, here they're going to actually purchase the shares of the company. However, you can have an agreement that hey, we're going to give you okay an option where you can buy our shares in the year 2025, okay, at the today's value. Okay, so assume that today's value is, let's say, $20. Okay, let me just share my writing area. Okay, for example, assume that the current share price in this is a market price per share in the year 2020 is, let's say, equal to let's say $20, 20.5. Okay, so you tell the managers, hey, we are going to grant you the option of buying our shares, buying the company share in the year 2025, okay, at a price of this value, 20.5, for example, okay. Now the managers, okay, don't forget they'll be paid for those shares for sure. In the year 2025, they pay the shares, but not at the market price then, but at the current market price of 20.5. So the best way the managers can maximize the value of this option by seeing how can we increase this market price If, for example, the market price, if it increased from 20.5 to, let's say, that 5.5, by the time year 2025 reaches, okay, and mean, therefore, they're going to buy the shares of the company, okay, at 20.5, but their true value is at 5.5, okay, which means, therefore, the managers will be motivated to seek ways of trying to increase the market value of the shares of the company. And how to increase the market value? By investing in positive NPV projects, okay, value-adding projects, okay. So the managers will be driven, will be self-driven to ensure that they make decisions that will increase the share price, okay. Now, as they increase the share price, of course, their value, their wealth is increasing, but more so, the wealth shareholder is increasing, okay. Don't forget P1 minus P dot, okay. The P1 is increasing, the share price is increasing. The value of the shareholders' return is also increasing as the manager try to advance their own interest. The share option plan, okay. So the manager have an option of becoming shareholders in future, okay, by buying the share price at a given price, okay. Then you have to call an ownership plan, okay. Executive share ownership plan. Now, this year you're going to give outright, okay. For example, in form of bonus, you give the managers, okay, bonuses. But these bonus are not in form of cash, but they're in form of shares, okay. These bonuses are in form of shares. So the manager becomes owners of those shares, okay. The manager becomes owners of those shares, okay. What you mean, therefore, they become shareholders also, okay. So since they are also part and parcel of the company shareholders, then of course, quite unlikely they will be taking decisions that will hurt their investment in the company. But they are also shareholders in the company. Okay, so they are also owners. They are managers, but at the same time, they are also owners of the company. Okay, therefore, they're making decisions that will be enhancing their value. Clear? Question? Okay. Then, of course, we have other means you can try to put across. One of them is incurring what we call monitoring costs. Okay. Now, here, monitoring costs means that you do, for example, hire auditors to go through the accounts of the company. Okay. We're going to be giving you an independent opinion on the company finance, or the truthness and fairness of the financial information provided by the managers. Okay. Design good contracts, okay, good contracts, contracting cost, okay. Of course, you have to incur costs as you try to design those contracts that are meant to bid your interest and the interest of the manager as well, okay. Then, of course, we have cost of restructuring. Maybe the previous managers, they acquired another company, okay, but that company was not a good company. So what do? You have to dispose it off, sometimes even at a loss, okay. If the previous acquisition made by the managers did not make any economic sense, they were what we call the pet projects, okay. They were not adding any value to you as managers, okay, as shareholders, okay. They were self-interest projects, okay, that were advanced by the managers. Of course, at the AGM, you can have intervention, okay, through a motion or making recommendations, okay. So these are ways that you, as the shareholders of the company, can try to protect your interests in your own company, okay. Question? Okay, there was a question that your examiner, which I think we saw it somewhere. Yes, this question 8. Okay, go through it, we discuss together. Okay. Okay, answer. Elvin. Elvin. Elvin is not in class. Okay. Sanya.
Yes, sir.
What's the answer?
I'm not sure, but I think D.
D. Which of the following students are correct?
Yeah.
Okay, so all of them are correct. You think so?
Yeah, I was kicked out of class for a while because of my internet, so I don't know if I missed something.
Okay. Don't worry. Let me just check someone else who was in class throughout.
Okay.
Nafisa.
Yes,
Yes.
I think it's B.
You think it's
B.
B for boy, 1 and 3.
Yes.
Okay. Collins, what do you think?
I think it's B as well.
You think it's B as well? Brian? Anita?
I think it's C.
C. Okay. Anita? Your hands was up, Anita?
So I think it's C.
C. Yes, and answer is C. Answer is C. Don't forget share option scheme. You think it's?
Yes.
C. Yes, answer is C. In point number 1, the share option scheme always rewards good performance by managers. Not always. For example, the share price may not always be within the control of the managers. The price might, like for example, okay, so the case of COVID, okay, of course, what happened to the share price? They did drop. Was it because the managers did not invest in value-adding projects? No. Okay, so sometimes you can reward managers, whereas they should not be rewarded because they did not contribute towards the increase in the share price. The same can apply also. You may, for example, you may not give them bonuses, not because they didn't deserve the bonus, but because of the situation in the market, which was beyond their control. Okay, that's why I try to say that at the end of the day, okay, they maybe have cases, okay, where you may be rewarding managers where they don't deserve. Okay, that's the point. Okay. So it's not always, okay, they not always reward good performance, okay? So the term here is not the correct term. Then performance pay can carry dysfunctional behavior. For example, okay, you may have cases where if you pay the managers a profit, it be a bonus based on the profit, what can they do? They may be involved in creative accounting, okay? So they want to be paid some bonuses. However, they are yet to achieve the target. What can they do? They can be involved in creative accounting. Don't forget, they are the ones who are preparing the financial statement because they can encourage dysfunctional behavior. Okay. VFM, value for money audit, I think we mentioned, is economy, efficiency, and effectiveness. Okay, so 2 and 3. Therefore, answer C. Clear? Question? Okay.